Welcome back for our last panel of the day, Resilience in Action, from Setbacks to Strengths. Banks have remained remarkably adaptable in recent years. This panel will explore how sustainable this resilience is and how much traditional banking will change in light of new competitors. Let's welcome the moderator Pedro Machado and the panelists to the stage. Pedro has returned to the ECB as representative to the Supervisory Board after a long career in financial regulation and supervision. Among others, he served for 5 years on the Single Resolution Board and worked at the Banco de Portugal and the European Investment Bank. Pedro will introduce the panel members and invite you to join the Q&A.
So, good afternoon again, and be very welcome to the closing panel of the first day of the ECB Supervision Forum. We will address in this panel an issue which is, I think, always in the minds of many, and in particular, I think, has been also in the minds of those that have intervened before in this conference, but not explicitly said, which is the issue of resilience. We know that today, and throughout this conference until now, we have been talking a lot about risks and an evolving landscape, which ranges from geopolitical to climate risks, from technology-driven operational risk to cyber risk, which prompts the issue of cybersecurity and cyber resilience. But it is also fair to acknowledge that banks have faced a series of challenges in recent years and still have remained remarkably adaptable, which might have not been by chance, and this is something that we also will try to discuss in this forum. So we will have basically sort of two core questions that we'll try to go through during this panel. The first being, what is the role of resilience in the light of evolving risks and innovation? And then the second looks a bit at the current challenges and the current competitive challenge as new competitors and methods and business models challenge the status quo. And so there will be, the question is, to which extent there will be space for traditional banks in the future. To discuss these questions, and I'm sure many other aspects that are related or interrelated with resilience, I'm very happy to be joined in this panel by, I would say, a remarkable representatives from different parts of both the industry and the regulator. So here I'm first joined by Fiona Gallagher. She's Chief Executive Officer of Wells Fargo Bank International and the International Head of Commercial Banking. She's active across the financial service industry and beyond, and she's chair of the Women in Finance Charter Committee in Ireland. And I'm also joined by Charlotte Gerken. She's Executive Director for UK Deposit Taker Supervision at the Bank of England. And at the Bank of England, she chairs the main executive committee taking decisions on supervision, policy, and risk issues. And further to this, she's also a member of the Basel Committee for Banking Supervision. And then Mijs is the Chief Executive Officer of the European Banking Federation and is also the industry chair of the European Parliamentary Financial Services Forum and the board member of the Salzburg Global Forum. So I'm really very honored to be joined by you and that you have also accepted to come to the ECB Forum, Supervision Forum, to share with you, with this audience and the audience that is, by the way, connected virtually, to share insights and to try to delve into the issue of resilience. So maybe we could start really by the question of resilience, and since resilience in banking has traditionally focused on capital strength, liquidity buffers. It is also the case that today, when we took it, or have a bit more of a broader perspective, resilience also today, when we discuss it, I was saying, has also to encompass adaptability to innovation, operational shocks, and reputational risks. So as this risk landscape evolves, so must the definition and the measurement of resiliency eventually complemented with qualitative measures and in particular also judgment be addressed. So with this, I would like to start with Wim and asking you, Wim, what indicators best capture a bank's ability to withstand and recover from non-financial shocks?
Ooh, thank you for your question. I must say, when I first got the question, I was rather nervous because capital and liquidity indicators have been with us for a long time and the metrics are well known and well researched. But I was inspired by the discussion this morning, by the speech of Claudia, of the adaptation and different ways of looking at how technology impacts risks, how operational risks is developing, and cybersecurity. And by the first panel, who indeed realized that digital is with us and it comes with new risks. But so I will try to give a number of indicators because the first step is close cooperation between the banking sector and its supervisor. Because, and I'm quite happy to say that with the single supervisor we have an excellent relationship, because you need to start by really trying to understand and grasp what kind of indicators will be useful to measure both from a risk perspective but also from a supervisory perspective. And I must say that the stress test that was done 2 years ago by the SSM and the way that was done, as also partly as a discovery exercise, was quite useful for that. So let me discuss 5 areas of indicators in a quick response to your question. For me, a number of questions. If you are hit by an incident, the first one is how fast can you restore your critical services again? And there are indicators like that, like the recovery time objectives and indicators that are quite objective in the way to measure that. But that is the first area. The second one, and another important one, is in my view the speed of detection and containment. How fast do we realize that we are under attack, and how quickly is the area that is affected contained? And again, that is measurable, but you can also go into the governance of the bank and the ability to decide. I give you one example that I ran into many years ago, is that there was a bank who had a cyber incident, and they had a perfect internal reporting system. And it took only 15 minutes from incident to incident being detected to the managing board being reported to. Except that after the incident, when they evaluated, they found out that their web care team was able to detect in 2 minutes. And so it's important that you take these indicators then back into the bank and you realize that speed of detection is important. Then, of course, data, protection and recovery of data. So again, you can also get that in very clear indicators on how you're able to protect your data. But also, and we've seen that recently with the DNS problem of Amazon Web Services, your failover success rate. How quickly can you adapt or change to another region if a region is under attack or has a problem? Then the fourth one for me is very much governance and the decision-making speed. So anybody who's, the moment they are taking the plastic off the manual, the moment an incident occurs, something is wrong. And the fifth one, and that is also covered, for instance, in Europe by DORA, is how to deal with third-party providers. So I think that in these 5 regions, you can create indicators already, and you can be relatively precise. And by doing that in close cooperation with your supervisors and learning, I think we are able to create quite clear indicators that are also very useful for supervisory practice.
No, indeed. No, I think you are also repeating or recovering some of the the topics that were mentioned
Absolutely.
early before. And
Absolutely, I was inspired.
yeah, exactly. And so it's good that we can also close taking also inspiration from the beginning. So very well. And just maybe picking on this because you mentioned issues that are building or resembling or resonating to operational resilience. I wanted to ask Charlotte, how do you see from your experience that banks have been balancing innovation with operational resilience and of course with the regulatory expectations or eventually also the supervisory expectations? But how do you see from your experience that this has been sort of coming to terms?
Thank you, and thanks very much to the ECB for inviting me to join this panel today. I've really enjoyed today's conference so far. I did just want to pick up on Pim's comment about cooperation, because I think when we at the Bank of England really moved from an approach focused maybe more on operational risk to operational resilience, so the assumption that bad things will happen, and it's about how you recover. It has very much been an approach developed with industry, and we do have quite formal and informal fora around both the preparation for events, but also then when certainly big incidents happen, how the industry actually comes together. So I would agree with that. On the balancing innovation, and has been quite a lot mentioned about balance today. Balance may suggest a sort of trade-off. I think on innovation and operational resilience, it can depend on the motivation for the innovation. So I think innovation and operational resilience can be in balance when innovation is an opportunity to build in resilience by design. There's that opportunity, and certainly for new players not encumbered by, say, legacy systems, to really build in that resilience as they innovate. But if the motivation is maybe a more immediate sort of cost reduction, then rather than longer term, then that innovation and operational resilience may come into tension. And say some of that kind of may be happening around how some banks have seen their use of third-party cloud service providers as a way to, say, reduce costs. It's been a way of enabling more innovative use of their data, but then does the contract they've got with the cloud service provider really enable them economic ready access to the data? So I think it does depend on that kind of motivation. I think the balance between innovation and regulatory expectations is something we're pretty focused on at the PRA, and we have to be, as we've got a secondary objective around competitiveness and economic growth, and both those associated with innovation. So we have to consider innovation when we develop any of our regulations, and we need to strike a balance between sort of predictability and certainty in the rules that will give firms the confidence to invest. But there is a balance between that and having rules kind of flexible enough so that firms can innovate.
Yeah, indeed. It's always the challenge of keeping innovation safe, but also not stifling innovation. So yeah, and maybe with this is a good hook to come now to address Fiona, and in particular from your experience, of course, and I think it's from the bank that you coming from, for sure that it's very representative in terms of the experience that you can share. But how do you see that on the base of that your bank is embedding sort of resilience in terms of your strategic planning and the governance framework? How do you see this been evolving over time?
Great, thank you, Pedro, and again, thanks for the warm welcome. So, listening to this morning and listening and considering the topic, it feels like we were living in simpler times when all we had to consider was liquidity and capital. Now it's really, to your point, how can we adapt to change, but also how do we handle those unexpected disruptions, and then most importantly, protect the reputation of our clients through the bank. And risk is just changing fundamentally. So whether it's cyber, whether it's tech failures, or whether it's that loss of public trust, we fundamentally had to revisit how we define and measure resilience and look at how we change it in terms of our approach. And so first of all, it's really, as we've been talking about today, starting with the real life experience of how a bank has reacted to an issue. To Wim's point, how quickly they react, how quickly they communicate, and how did we, or the bank, respond to something when it went wrong. And that's really the best situation to figure out how we should look forward. So we try not to look in the rearview mirror, but obviously it's very important when there is something that has gone wrong that you take that after action review and you really look at building that into the future, because those are the elements that are very unpredictable and were very unscripted. The next best thing, and we've been doing this a lot, is obviously testing. And so, you try and avoid the scenario, just the tabletop scenarios, but actually really try and do a live fire drill, and you try and make it as complex as possible. We recently did, and I'm using my new terminology, war games. We recently ran a war game within the EU entity. And it was interesting. First of all, the cyber piece went quite well. We could understand what we were doing. We were well briefed. People understood that they shouldn't go deep in trying to solve the cyber issue. Our issue was to respond, and our job was to respond in a different way. But we actually very quickly started layering in other elements. So yes, we had a cyber issue, but we still had to make payments for our clients. We had KYC challenges that we couldn't actually see. So what were our responsibilities? And it was by adding in the layers into that scenario that we really saw the true challenges that were coming out. And so then taking those points, it's really looking at how do we embed that into our governance frameworks and also into our models. And I think historically, we've looked at operational risk or resilience really from a BCP or technology perspective. Mm-hmm. Now it's about putting it into everything we do. And to pick up on your point, Charlotte, it really is in the design phase. So for example, new product that we're designing, we know it's got to make lots of payments, for example. So that's very straightforward, right? We put it into the design, into the controls, into the computer system, into the database. But now we actually need to think more broadly, really a broad-based approach. So we're looking at our vendors, and the approach that banks would normally have taken is where's the best talent, where's the cheapest provider, and now really that's not the case. The starting point when we think about our vendors or third-party relationships is around concentration. So again, it's layering all the different elements to come up with an approach and then putting them into your governance frameworks. But also importantly, they have to be dynamic. You keep having to come back to them. And also you need to keep looking at them with the lens of maturity. And I think when you do all of those sorts of things, you really will emphasize how you need to adapt, but also you're very conscious of the internal processes, the external stakeholders. But it's not one and done. Every exercise that you do has to come back. But I think the biggest issue for us now, as I said, is all the complexity, but particularly around the vendor space or indeed the digital space. But I do think the advantage when we think about innovation and digitization is that we're designing things now. And so again, we can layer in those processes or those frameworks really today and make sure that we're taking that broad brushstroke.
Yeah, indeed. This is very interesting that what you're saying, in particular also the issue that the relevance or the importance of also testing, so conducting fire drills, dry runs, which I think are of the essence in terms of readiness and preparedness for coping with these shocks. But also you mentioned a point, and I just don't resist to see what are your views, is this third-party service concentration that we have in terms, in particular for cloud service providers. To which extent do you consider the sort of robustness of the mitigants that you can put forward? and also in particular thinking about in terms of the leverage that you can eventually have in terms of the contractual negotiation. Do you come across with this challenge?
So I think a big thing, not only for us, but across all of the larger banks, is now really the red line with regards to vendor management and outsourcing. Historically, you might have liked to work with someone, and if they're, if the arrangement or the contract was 90% there, you would certainly think about, look, that's something that we can do and something that we can execute. What we're now seeing systemically is that there is no appetite for that, that you're setting the benchmark and you're really working with the industry, you're coordinating to talk about best practice, and then you're really trying to drive that through with the vendors. I would say we're not always 100% successful, but that really is from, CEO down of the group, that really is the approach. And I think it came across very strongly in all of the panels that this approach, whether it's outsourcing, vendor management, all of the additional elements, all of those now, those key decisions are at a group board and executive level. Historically, we would have thought about, let's say, procurement, and it would have been managed perhaps at a much lower level, whereas now it is absolutely critical that it's managed at the top. And any decisions that move away from that kind of red line, really can't be taken by individuals who mightn't see the broader impact.
Yeah, I see these decisions being taken as board or strategic issues are not just the operational resilience side, but just the business critical, the link to, say, geopolitical risks as to determining where you might want to take your business may depend on where your third party cloud provider is, or indeed other suppliers as well.
Exactly. So, and there you can see how also then this shapes governance. I mean, as you rightly say, that this of course requires certain governance changes. And with this, maybe we can move to, and I think this was a very good starting point to frame the discussion. And now taking a bit to the perspective of the supervisors, how we are seeing, and also I would be interested to hearing to you. But it's true that the supervisors have been sort of focusing on resilience as a systemic safeguard. So, and as we said at the beginning, this is today not restricted only to financial soundness. We have this critical dimensions on operational continuity, cyber resilience, and of course this will, as we just saw, shaping also then the broader governance framework within the banks. So the challenge here also lies in aligning sort of supervisory expectations with also the pace of change in the industry. And here, again, Wim, if coming back to you, how do you see that banks can demonstrate resilience, but without relying solely on quantitative metrics? I think this is close to your heart.
I've always wanted to put on the hat of a supervisor, so this is my chance, and I'm in the right building. But going back a little bit on concentration risk, because one thing is, for me, moving to cloud services was not so much cost and also concentration risk. I'm still from the banking area when we all had the same IBM mainframes running all on the same software. So in that sense, we come from an era of high concentration risk. The difference was, of course, the physical ability to deal with the data, both for the banks who had them in computer centers and for our supervisors who were able to check the data and check the computer centers. But for me, the reason to move away from that is pure survival. If you look at the ability of cloud and data in the cloud, both cyber resilience, updating, patching, the whole system, any bank that still relies on their old computer system is at huge risk, in my view. So that is, for me, the big step forward. Now, indeed, many of you will have been in cybersecurity centers of large banks, and it looks a little bit like the control center of Houston. And that shows the value of metrics, because there you constantly get, everywhere in the group, you constantly get on these huge screens, you get data and direct cyber incidents, and you see what's happening elsewhere in the world. Now, from a supervisor's position, actually, I think that Fiona just demonstrated exactly what you should do towards your supervisor, because it starts with good governance and clear roles. Who is responsible when? And again, I give you an example. I've been in this for some time, and I remember doing a national exercise where the critical escalation committee started discussing its mandate during the crisis. Wrong. Yeah, it sounds simple now, but it actually happened. I must have looked pretty stupid when I saw that happen before me. So clear roles and governance, again, very much as was said by the other panelists as well. And from that comes fast decision making, but also the running of simulations, the war games, the red teaming, but that needs to then institutionally being demonstrated that it's being taken, that it's a learning organization, so that the results of these war games and red teams are not just a nice afternoon out, but that they are really and physically then implemented in the organization. Then indeed, again, what was mentioned, it starts with infrastructure design. How do you design your infrastructure, and are you realizing what you're designing? And so, indeed, the resilience should be built in already in all the designs. And then, finally, again, for me, it's a learning capacity. I run together with the SSM a CIO roundtable in which the CIOs of most European banks are part of, and we discussed the stress test and the results of the stress test as a learning exercise. Absolutely very important, but also black swan events. So what happens if one of the big banks in Europe gets hit by a ransomware attack in one of its liquidity critical departments, like the Treasury? Then we have a serious problem. And again, the reason why this is so important, and I cannot stress that enough, these are not problems of an individual bank, these are problems of the financial system. And that's why we need to communicate so openly on that level. But then also, indeed, the concentration risk. And that is indeed where our competition authorities come in, and we are in close cooperation with them. Because, in my view, we have to create some kind of power to countervail, certainly also the large vendors that may be under geopolitical pressure as well, and we have examples of that. So there is political risk involved as well, and this is again where we need to closely work together. So, in short, we need to demonstrate very clearly in our governance that we are able to deal with operational risks, and that is what I would want to see as a supervisor, and clearly demonstrated by the supervised.
Indeed. But I'm very happy that you say that stress testing is also a learning exercise. We'll take this as a good outcome of this.
If I'm fired after this panel, I said something wrong. But I actually, in cyber, I absolutely believed in that. By the way, it is also a learning exercise for the supervisors.
Agreed.
Point taken. Charlotte, when we see this innovation unfolding, which also brings new players into the market, to the sector. Are you concerned of eventually possible uneven level playing field momentums or instances between the traditional banks and the new challengers, in particular because of different regulatory requirements that these latter are facing?
I supervise quite a few hundreds of deposit takers from sort of the largest global systemic banks to very small sort of amateur-run credit unions. Everybody feels that they are on the wrong end of the playing field. So I think whether the state of the playing field, there's different views. And I suppose the concern kind of may vary as well depending on what sport you're playing. I think I better leave sports stuff there because that's as far as it goes. But I know, there's a bit of a difference whether you're playing lacrosse or lawn bowls as to how level the playing field needs to be. So I don't sort of spend too much time sort of worrying. I mean, I get a lot in both ears on the levelness of the playing field. And we do have to consider a competitive sort of landscape. But the focus for me as a regulator and supervisor is, what is the risk to financial stability, and holding that in mind. So what is the impact of the player on financial stability, or what is the impact of the particular service on financial stability, because it's not always sort of about the balance sheet size. And we do have different requirements depending on the answer, and deliver those requirements through proportionate supervision. And that's intended to support growth, but also not undermine resilience. So it's more straightforward and in metrics terms to talk about, the financial resilience side, where, proportionality is codified through regulatory thresholds. So we do have, say, different strategies for dealing with bank failures, depending on their balance sheet size and the volume of transaction accounts they have. And in the UK, we've deliberately set up a regime for small domestic deposit takers to simplify sort of regulatory requirements. So sort of help them not spend so much time worrying about the complexity of regulation, but spend time sort of growing their business. And similarly, we have as well as our new banks startup units, we've just launched a scale-up unit as well. So that is a deliberate sort of effort to support those firms at the smaller end. I mean, for operational resilience, we did take a conscious decision to have the requirements for all banks and insurers as well, but those requirements are applied proportionately, and again, that's how critical their services are to financial stability. So my concern is more where a product or service may look the same to a customer or market, but there is a different level of protection or security or rigour. And whether the incentives for the market to take those into account are kind of really accurately and well informed as well.
Mm-hmm. Yeah, indeed. Now, we mentioned before, and now, I mean, coming back on the issue of resilience and the impact of in innovation and technology and sort of keeping operational resilience of the banks. Clearly, there is also an issue that sometimes is very much neglected, but I think this morning, at least in the first panel, this was mentioned, and I think it's an important one, is the sort of banking culture that enables innovation to be incorporated in the processes, but with the adequate sort of frame by the adequate safeguards. In your experience, Fiona, what is really here the role in this particular case of building a resilient banking culture for leadership? How do you see the role of leadership evolving and being sort of more relevant to build this or to contribute to this sort of resilience framework?
Yeah, so no, thank you. So I think it's absolutely core, and I was thinking about it earlier. We talk about you can buy technology, but you certainly can't buy your culture, and I think that means that culture and leadership are intertwined, but also there has to be ownership at the top on all the levels. Speaking organisationally, we obviously have gone through about 6 years of significant change in my own organisation, and it was really led from the front. And sometimes that meant there were, forthright or blunt conversations, but it was all about transparency, all about the goal, all about a clear plan. So a lot of detail, a lot of ownership, no surprise to everybody. It's about the Monday morning meeting where you really talk through what has to be done this week, and then you come back to it next week and you speak about what went wrong and how can we solve that. And there's really no substitute for that. And I think when you're going through a challenge or you're doing an after-action review, whether it's a transaction or a crisis, I think you quickly have to identify as well whether you have the skill sets within the organisation, so bringing in expertise perhaps on controls or design, But also, as well as that, you need to create that followership. So I think one of the things that we've seen importantly in our own journey over the last number of years was promoting the talent within, as well as marrying that with regards to the expertise that you might bring from the outside. The other thing as well, and particularly if you think about resilience and culture and interaction with the supervisors, I think it's critical that we see, that open communication, that transparency. Also, as well as that, as much as you're bringing the team inside in the journey of the change or the resilience or the remediation, it's also about being very clear with regards to the regulatory landscape as well. There was an article last week which described, I think, our 3,000-page plan for change. 28,000 people who worked on, a lot of the remediation within the firm. But again, that was led, by all, led, and again, explaining the why of why you're dealing with the challenge and how you're going to do that. And then the other thing as well is recognizing, particularly for banks, that if you have a crisis, you still have clients, you still are trying to drive revenues forward. So when you're in the midst of a big challenge, you have to figure out what to do so that you're not standing still. In the case of our firm, we had a public asset cap, so it was how could we continue to grow the business without having the impact on the asset side. So we were talking about it earlier, this time of year means everybody's extremely busy, but the one thing that we are very conscious of is that when you're in the crisis, that you also have to protect the business that you have. And a large part of that is through communication. But if you do not have clear expectations and clear deliverables, and you're just relying, for example, a case in point was this morning's panel, if we're going to rely on AI to solve our problems, that's not going to do that. We're going to have to see what AI can tell us about potential solutions, and then it'll be up to the people to deliver and to integrate. So I think culture and leadership is key. It goes back to the panel just before us. We've learned a significant number of lessons since 2008. And I think culture and banking culture and the improvements and focus on it are probably the largest areas of focus. And I think positive improvement that we've seen.
Yeah, this was one, exactly. I was also kind of impressed in this morning's discussion to see the awareness or that digitalization, but in particular technology-driven innovation and embedded in the whole business model in the process also requires eventually much more availability at C-suite level. And clearly this seems to be now a sort of also condition, which is not coming from the supervisor necessarily. It's something that you would agree that is something that is felt within the organization.
Yeah, I think that's a really good point. I think if we're dealing with a lot of corporates, we're dealing with a lot of financial institutions. If you went to any firm now and they told you they didn't have an AI strategy, I think you would be extremely nervous. And so we can't have that expectation on the clients that we deal with without having that expectation within. We spoke about it actually at lunch, which is certainly if I look at my own firm, we have, like everybody else, Copilot is in. We introduced it slightly more slowly in the EU to make sure that we were doing it in the right way. But actually, it's encouraging people to use it. So to the point I think Andrea made of, how do you get the more senior, maybe more longer tenured people in your firm to get using it? You don't just say it's about the work that you're doing. Talk about, bring in simple things so people just build up the familiarity and also, just get used to using it day in, day out. We, for example, have just built, over the last couple of years, a new system for our commercial banking and investment banking clients called Vantage. And we sat there. AI was designed at the beginning, but actually the reason it's been successful is that we just didn't build a system and hope that the clients would like it. The first thing we did was design personas of every type of client and person within the client. So somebody from operations who might require one type of information from the system, a CFO who might be looking at something else. And we understand your clients, you design those personas, and you bring it together with the innovation and indeed the sandboxes that we're seeing. It really creates a much better product. But again, you have to have that client knowledge to tie in with the artificial intelligence piece.
I don't know, Charlotte, if in the UK you're also feeling that the banks are feeling this growing need also to escalate the sort of leadership in terms of technology. Now that we are going forward, all banks are going forward with AI embedded functionalities, tools. Are you seeing the same sort of trend?
Yes, certainly. I think some of the largest banks, I think as Fiona says, not deploying AI is a kind of reason to worry as well. And we do have some of the sort of mid-sized banks actually asking us, are you going to develop more regulatory expectations on AI? Because these developments, they do take investment. So there is a point in scale for firms. So say some of the some mid-tier firms who may not be so designed into sort of innovation, kind of wondering what might be the constraints that a regulator may put on AI that could perhaps stop others moving ahead so rapidly. So to date, we've been technology agnostic and using our existing rules to address some of the risks in AI, recognizing the opportunities. So we've got, I think governance is where it needs to start. Accountability for decision making, model risk management, data. So we have got expectations in those areas. I think in time, artificial intelligence is different, and certainly the sort of the challenges actually to governance and accountability are such that I would anticipate sort of more AI sort of specific expectations coming in. But as Fiona says, we're learning as well. We're deploying AI in our business, and I think it's really understanding it from the inside before sort of then working out what are the appropriate sort of regulations. And cooperation, I think, again, with the industry will be important.
By the way, and I cannot resist him, do you think also, and I think because Charlotte made a very good point in this sense of that AI maybe is going to raise a challenge of its own. I mean, that...
I absolutely agree. Absolutely. AI is a challenge of its own. And at different levels. It first starts a little bit like, sometimes I have a feeling that there is a fear of missing out. There's so much talk, and if one person asks, what are we talking about, you get silence. So that's one. The second level is that AI can really also have serious risks towards your clients. So if you have a wrong, and we all know that if the algorithms in these large language models are wrong, then you get redlining or you get exclusion, and this would be detrimental to the reputation and the service of a bank. So yes, it has all sorts of problems. Then you have all sorts of vendors who come in and think, okay, these people are above 30 years old. We just sell them process optimization at a high price as if it's AI. So at several levels, it's a huge challenge. But the interesting thing is how to use it and how to develop. I personally do not find Copilot the best example because it sometimes reminds me a little bit of the Microsoft paperclip of a few years ago. But there are clearly large language models that really help, and to get people to engage and to see the possibilities on one hand, and on top management to be really well informed and interested on where it can actually help clients and processes and not introduce new risks, that's essential.
You could switch off the paperclip there. I'm not sure you can switch
exactly.
off Copilot.
Copilot, no, it has been, exactly, I've been trying that, yeah, exactly.
I was going to say just two trends that I'm noticing which are interesting and tie into your point is you're talking about a round table of CIOs, but recently we have, obviously CISOs, but the latest thing is cyber human defense. So a lot of us have now, new teams built not just on looking externally, but looking within internally to make sure that we are capturing the human risk within. but also starting to teach, we had Cyber Week in October, starting to teach people how to observe what is AI and what isn't. And I think that's a skill set that we will all need. And then the other thing that I find interesting is just over the last couple of weeks, there's been a lot of announcements about branch expansion in different locations.
Exactly.
And I do think it's something that we will see the benefits of this, but as we also see potentially the risks of AI, will that drive people back into branches, particularly for some of those decisions? So I think it's all of that. We're very much learning, but I think 10 years ago we would have said branches will reduce. We're seeing expansion everywhere. Part of that obviously to deposit gather, but equally I also think there'll be a secondary advantage of people getting back into in person. So again, cyber human defense was new for me, but it's
this is
certainly
super important, because also in the recruitment process, let's just say I go crazy with the amount of application letters for a function that I get that praise me on my inspiring leadership of the European Banking Federation. And that tells me a lot, namely that ChatGPT is applying for the job and not the person who says they are applying. Sorry.
Remember that.
Exactly. I go crazy with that. I all hire them, Frank.
So that's let's hope you will not end up being replaced by AI. For sure, you will not. But coming back, and by the way, I think here one important point that building on what you just said, Fiona, but also with what Charlotte said, we are also engaging, from our perspective as supervisors, we are also embracing AI, and I think the value in particular of training is of the essence. We also heard this morning, and I think it's not only training on AI, but there is also maybe a part of a generational workforce that has also to be trained to cope with this innovation. But I think this is one of the findings, the relevant findings. So I think we don't have much time left before I have to hand over to the audience. Which we'll with pleasure. It's not a duty, but I wanted just to have a sort of wrap-up final question, because we talked about many issues which are sort of ramifications of resilience. So resilience really has many sort of dimensions that we touched upon a bit in loose terms, but I think this was a bit the richness also of being in the panel, and it's a bit more, how do you see, and now a bit in a candid way, that with all this landscape under which we are evolving, from this more challenging, evolving risk landscape in terms of the new risk drivers, to an environment which has to be more agile, more tech-driven, and which will lead naturally to new players coming as they are challenging. How do you see that the possibility or the sort of strategy that has to be adopted by traditional banks to remain competitive? And of course, if there is really a space for traditional banks in the future. Who wants to start?
Well, the question is what you call a traditional bank.
Yeah.
Because the laws of evolution apply. If you don't adapt, you're extinct.
Yeah.
And that is, I think, the first. And I see banks adapting very, very quickly. So for me, it starts with for me, the fact is banking is a profession. It's not just like if I put on a white coat, I'm not suddenly a doctor. If somebody puts on a suit, they are not suddenly a banker. This is a profession that has to do with understanding resilience, fighting fraud, managing payment systems, managing balance systems, creating trust, delivering to clients. This is one thing. But if you stand still, if you don't adapt again, the needs of society and the needs of your clients are changing. So again, the moment we don't move, you see immediately that somebody moves in. For instance, when my son studied in the United States, I didn't even think about using a bank to transfer money because I moved to Wise, because otherwise it would be both expensive and untransparent. So it shows. And the same is, like if you look in Europe at banks like Revolut Or I was in South Korea where you have TOS Bank, which is one app that designs your full financial health and environment. You see that happens. But what I noted in TOS Bank, and again I come back to the role of what we could call traditional banks, they also had a 24/7 call center that was able to cater for every need. And every need. If you needed a complex mortgage at 3 o'clock in the morning, you would get it. And that shows the changes in society. At the same time, they also had a center for at that time they called it that, elderly citizens who want to become more digital. So you see that the human factor is still there. So in my view, there is absolutely a role, and we've seen it here because all of the institutions here are more than 100, if not even more than around 300 years old. There is a role for banking if it adapts to the needs of its clients and the technical standards and the needs of society. And if you don't, then you are extinct, but then you should be.
Indeed. Charlotte,
Yes.
if you go provoked
I can tell who
by age.
Yeah, who's the 300-year-old in the building? Yes. And I think, Richard Nodder started, I think, this competition on age, but in saying that Goldman Sachs is 156 years old, and there because still adding value. And I think that even for an institution that was founded in 1694, we've had to renew our whole payment system, our real-time gross settlement system, to support the needs of the UK financial system, the UK economy as well. We're having to really adapt and think about how we cope with digital assets. So some of it is about actually sort of kind of leading by example, that even traditional banks and let's say you have to kind of keep changing to survive. I think what I have seen over the last at least sort of 30 years that I've been supervising, and supervising mainly banks, but insurers as well over that time, is how even with traditional banks, which I had associated with being more like full service banks, the competition moving to specialisation, competing along particular business lines. And so that's sort of in a way how I see it. And will that sort of trend continue? Possibly that specialisation, it does bring with it some concentration risk, but it's sort of kind of where can you better compete, and also then compete at scale, and thereby improve resilience as well through that scale.
So Fiona, you were telling that Wells Fargo is 173
yes,
years or so.
Sorry, Richard.
Each panel gets more incremental.
Exactly.
So just for tomorrow, if everybody could have the history stats.
So you had to adapt over these years.
I think exactly, and if we think about how we started as a firm, it was the stagecoach transporting the money across the US. But I think the whole point as well is that I do think fundamentally we should have some confidence in all that's happened since the crisis. And I think as much as we're watching innovators, we're watching disruptors, we're also partnering across, whether it's with technology, we're partnering with private credit. I mean, there are partnerships. We have one in particular which is focused on middle market lending. But equally, I think when we see, as Wim said, operators in the market that can deliver simple products much more quickly for us, then I think that's on us to actually take a step back and look at how we ourselves can innovate and adjust. I think when I talk about the confidence, I also talk about the fact that we are now, if somebody new was coming into this space, I would say a lot of the risk and control and reputational issues have been worked on. Not to say there can't be improvements made, but there is a lot of trust in the system. There is, as I said, the bricks and mortars concept, but also the advisory concept. And so for us, adapting, but also not being afraid to be more confident, to partner. But then as well as that, if we are falling behind in certain areas, it's up to us to correct. I think we've all been extremely aware of some of these participants for the last 10 or 15 years, and now I think most banks will see, will have truly, strong digital offerings. And now the great thing as well is, for example, with us, it's English and dealing with the demographic changes in the US, Spanish as well, and all of our digital systems. So I think we're learning a lot, we're adapting. Partnership and confidence would be the key areas that I think we have to focus on.
Thank you very much for this. It was great insights. Thank you very much for having shared and amongst us. Now I would open the floor to the audience.
Thank you. Very interested in the focus on operational resilience. When you're looking at financial risk, there are lots of metrics that external stakeholders can consider to see about the relative risk of individual financial institutions. With operational resilience, it's much, much harder. Is there anything either from a regulatory perspective or from a bank CEO perspective in terms of managing your stakeholders that you can point to that says, well, X financial institution is clearly more risky than others, given it's a tail risk when we're thinking about kind of those really big outages. Thank you.
Who wants to take this question, please?
So the one thing that I think that we can say as the industry is if there is an issue with another bank is how quickly we can adapt or look at the situation that was there and do a read across to us. You can see it, for example, with some the examples of some of the banks a couple of years ago. Immediately, it was what's the read across to our portfolios, being more public facing in terms of talking about the nature of our loans, the nature of our liabilities. So there is a huge amount of focus now at any of the conferences, investor conferences around that. But I would agree, it's definitely challenging. So I think it's talking through that, publicizing and talking about our frameworks, I think is a good way to go. I was looking to Pedro to opine on which banks were the riskiest, so I won't go there. But I think our job in the industry is every time we see a crisis, make sure that we are after action review, what's the read across, how can we deal with it? And we do, Britta was here earlier, we have extremely intense investor dialogues and they are putting us through that. And then, we see that coming out through the reports.
It is hard there's a lot of work done to categorizing the different levels of risk. But indeed, it's not only bank specific, but also indeed, as I said earlier, systemic. Because again, certainly a successful cyber vulnerability of cyber attack is something that has a risk to the sector. And that's indeed why you want to categorize the different levels of risk, and a lot of work is done there, but it's quite difficult, as you rightly point out.
In setting, we set a deadline for firms to sort of come into compliance with our expectations around operational resilience, but they weren't necessarily, I suppose, in order to get there, and that was to really just kind of focus and get a bit of momentum, more on the inputs. So we were assessing whether banks had even managed to identify their critical or their important business services, whether they'd mapped them, how they're reporting, what was the involvement of the board, what scenarios had been tested from those, and then the response and lessons learned from those testings. So we were assessing across those. We want to get to a position where you can really kind of assess the sort of outcome. But I think taking this approach, sort of at least, it's getting firms into the right. I think the culture, the kind of mindset to sort of explore just how resilient they are.
Thank you very much. I see a question there, a hand there, please.
Yeah, thank you for taking my question. It's Britta from Autonomous. I think Fiona briefly touched on digital assets, and I know we always discuss geopolitical risk in terms of credit exposure, market exposure, and operational resilience. But operational resilience also impacts deposits, and that is a big discussion point amongst investors. The rise of stable coins and the debate how to treat stable coins versus tokenized deposits. Maybe you can give us a little bit of insight where you rank that sort of risk, whether you run scenarios on it.
So for us, in terms of what we're doing within the EU, we haven't looked at that. I think much more developed in terms of the parent in the US, not surprisingly, and also encourage very much as well to take a look at that and take a look at it particularly across our wealth management and for our CIB side. So I'm probably not the best person to answer it for you, Britta.
I mean, on the, we've taken view that that deposits are what banks are about, and that's about money creation. So tokenized deposits could be issued by a bank, but not stable coins. Now, banking groups will have, no doubt, stablecoin operations in their groups, but it's in a separate sort of part rather than out of the bank itself.
Very good. I don't see any hands. So this is because we are really at the 5:15. I think
that the lights on and off try to signify something to you.
I think that was a matter also of operational function.
Yeah, it was exactly a stress test.
So if there are no questions, it's just for me to, again, thank you very much for having joined the panel. It was a great discussion. I think you were very candid and very open also in sharing not only expertise but experience. I think that's what we wanted to get out of this panel. And with this, I would just invite everybody for a round of applause for our panelists. Thank you.